So Andrew, the theme of this year's Credit Suisse Asian Investment Conference is disruption as usual. What are the one or two biggest potential disruptions you worry about in global equity markets in the near term?
About 4 years ago, we wrote that there's going to be so much technical disruption coming that anything which was half good was going to be doubly good. So anything which isn't disrupted is going to trade on an abnormally high multiple. I think in many areas, less obvious areas, people are underestimating disruption. So I think we're going to see much more disruption in the utility space through areas such as smart metering, people taking themselves off grid through battery storage and energy switching technology. I think we're going to see much more disruption than people expect in big cap pharma, which we've written on. And even in areas where the disruption is obvious, such as retailing, people are still being surprised by the impact this is having on retail REITs and the retailing sector. So I do think indeed it is one of the biggest themes.
And just looking at individual markets or economies, which do you think has the most potential to surprise investors this year in a positive or negative way?
I think on the positive side, it is actually our home base of continental Europe. What I find is investors have completely given up on Europe, and even if they believe there's a recovery, they're not willing to invest in it because they believe the European construct with places like Italy is wrong. Right now, if you look at one of the best indicators of growth, which is PMI new orders, it was only lower, basically, in the global financial crisis. And I don't see a repeat of the global financial crisis. So it's going to move up, and cyclicals will outperform with it.
Technology is obviously having a massive disruptive impact in many sectors. Are there any particular subsegments of technology that you're especially positive on this year?
Our biggest overweight every year since 2010 has been software. It's been an incredibly simple story. That because lots of tech, but particularly software, enables cost cutting, software spending did not fall in the global financial crisis. So it's defensive, and it's got net cash on its balance sheet. It's clearly growth. IDC say the amount of software spending, amount of data rather needed to be analyzed by 2025 will grow 50-fold. And meanwhile, the valuations are reasonable. So we particularly like software. When we look at cyber, we find the cyber stocks are trading on 1.8 times 2021 sales. And we still like gaming. The PE of the gaming stocks relative to the market was only lower in the financial crisis.
Thank you, Andrew.